Hi, everyone. Today, I have the pleasure of introducing Ryan Berlin, Director of Intelligence and Senior Economist at Rennie. Ryan has been a huge supporter of NAIOP over the years as a speaker, resource, and fellow board member, and I, for one, am always excited to hear his insights, as most will agree that Ryan and his team at Rennie have some of the best data in the business. Ryan will provide an overview of some key economic, demographic, and housing trends in Metro Vancouver from pre-COVID to present, identifying which factors impacted our market and which did not, before dusting off his crystal ball to offer his thoughts on how the coming months and years will play out. Should you have any questions, please do ask them in the chat or Q&A function at the bottom, and we will do our best to ask the consolidated list of questions at the end should we have time. With that, Ryan, over to you.
Oh, there we go. Thanks, Devin. Appreciate the words. I'm just going to share my screen here. All righty. Let's see. How are we looking? I'm going to assume, because I can't see anybody, that
looking good.
This is, oh, good. Thank you. Thanks, Devin. Great. Yeah, good, I guess, afternoon, everybody. I appreciate everyone attending today. I know we're probably all at wit's end with virtual meetings and webinars, all zoomed out, as they say. But you know, hopefully the end is in sight. I know at NAIOP, we're looking forward to live events in the near future. UDI is hosting my colleague Andy Ramlow next month with an in-person lunch. And so, yeah, I mean, the world is changing. There's a feeling that we're getting back to quote unquote normal, whatever normal is, whatever life was like before the pandemic. I almost don't remember. But what are we doing today? Okay, so for the next, I guess, 40 minutes or so, what I would like to do is explore some of the data describing our economy and our housing market here in BC and in Metro Vancouver, as Devin said. For much of today's content, I will be leaning heavily on the latest edition, so the fall 2021 edition of our Rennie Landscape publication. So this is the Rennie Landscape, this little red book, which I know makes its way around the industry. We also have a digital version of it as well. We write it once in the spring, again in the fall. It's really written from the perspective of examining the wide range of factors that are impacting our housing market, because we are a largely residential real estate firm. So that is generally the focus, but it's really all the direct and indirect factors that are influencing it. And so things like economic trends, demographics, interest rates, inflation, government policy. So yes, it is sort of geared to ultimately an audience who is interested in or stakeholders in residential real estate. But its applications are broader. It's really for anybody, I would say, who is just sort of interested in, our take on the world, but also just, the things that are influencing our economy, our migration flows, and then obviously certainly housing, but you could extend that to the commercial real estate space as well, as it ties back into how the job market is changing. So there is a lot in the landscape. I know some people use it as a sleep aid, but it's not really meant to be read front to back, right? So it's written in these bite-sized morsels, so you can dive in, come out, dive back in somewhere else, and just take what you need from it, and you can ignore the stuff that you don't really care about. There is a lot of stuff in there, but essentially there are three themes sort of that emerged from this recent edition of the landscape that I'll lean on here, to structure this presentation. The first is that we are very much still in pandemic, what I would call recovery mode. So when we look at the unemployment rate, the job vacancy rate, interest rates, inflation, with the exception of the last variable, all of those are still not back to their pre-pandemic level. And I would say that the fact that inflation has surged in the way it has really speaks to the fact that there are some, we're in a disequilibrium state right now. in our economy. And when I say our economy, I mean, you can apply it wherever you want, nationally, provincially, or regionally. Having said that we are distinctly in recovery mode, even though things feel so much better than they did 6 months ago, and certainly compared to a year and a half ago. We are in recovery mode, but this part of the world, this part of the country in particular, is doing comparatively well in its recovery. So when we talk about unemployment rates, we have some of the lowest in the country here. We've got employment in British Columbia and in Metro Vancouver that is now above its pre-pandemic level. Way off of trend, obviously. If we hadn't had COVID and had there not been some other sort of cyclical event, like a sort of a non-pandemic related recession, the job base would be significantly higher than it is now. We know that. But I think there's something to be said for hitting that milestone of the pre-pandemic employment peak, which we have in the past few months. We've dealt with COVID, I would say, comparatively well, or we've gotten lucky, or both. But I'd say when we compare this, jurisdictions on the West Coast to the rest of Canada, and certainly south of the border and even globally, we're fortunate. We're doing quite well. Then as we look ahead, I don't actually have my crystal ball here. I never actually know where it is. But just looking ahead, talking about some of the factors that I think will be important in shaping this market in 2022 and beyond. I'm looking at things like job growth, the hordes of migrants that are expected to continue to want to call Metro Vancouver and British Columbia home. And then you look at other things, other factors, non-demographic factors, like the huge accumulation of household savings actually over the past year across the country, which on the one hand has been deployed in great sums in areas where money can be spent. So a lot of it had to do with upgrading homes and sort of more local spending, let's say. But there's still, and deployed into assets, real estate. But there's still a lot of money out there to be spent. I think the estimates right now are that there's about $100 billion-ish of $100 billion-ish in Canadian household bank accounts. I don't have that in my bank account. I'm not sure who these people are, but on average, that's how much the Canadians are saving, right? So anyway, so there are some tailwinds. I think that there's some risks, but there are some tailwinds that are pointing to, I think, a favorable year next year. So there's a lot more in the landscape. I would encourage you to visit our website, rennie.com/intelligence. I'll put a slide up at the end. And you can find the landscape there and all kinds of other reports. And also we have a podcast, the Rennie podcast. So if you want to listen to that, we have a couple episodes a month. So I'd encourage you to check that out through Google, Apple, and whoever else, allows you to subscribe to podcasts. Alrighty. So let's start talking about where we're at right now. For that, I want to start at sort of the beginning of the pandemic. So we're going back to February of 2020, seems like 10 years ago. I don't think any of us I don't think it was possible if you weren't, in a health-related field to really understand what this situation could turn into. I mean, I thought we would go home for 2 weeks and be back at the office. When I found out it was 2 months, I thought, wow, I mean, we've never seen anything like that, not being in the office for 2 months. Here we are. Some people had more sort of simplistic takes on it. I mean, here's Donald Trump's take, said, like a miracle is before it really landed on our shores with its full force. Like a miracle, it's going to disappear. And it's all going to be better. And obviously, not many people sort of shared his extreme view of it, but none of us really knew what to expect. And here we are now, 20 months later, still talking about it. And we will be for years and years and years. So just getting to the first insight here. Again, that we are distinctly in recovery mode. This applies to this region. It applies to BC. It applies to Canada as a whole. So how are we in recovery mode? Why do I say such a thing? So the first chart I've got here relates to total employment, the number of jobs in our 3 largest metro areas in Canada. I've indexed it to February of 2020. So that's where you see the 1, and I've indexed it so that we can show all 3 regions' employment levels on the same chart, on the same scale. So index it to prior to the pandemic, and you can see within a few months, 2 to 3 months within the pandemic, all 3 regions have sort of bottomed out in terms of the employment shortfall. So here in Metro Vancouver, that is the red line here. Employment fell or was suppressed by 18%. I mean, it's just totally, you know, I hate to use the word, but unprecedented, right? We'd never, in the worst recession and depression, we hadn't seen anything like this over such a short period of time. At that time, we said, hey, what is we're going to recover because we're going to reopen the economy. The reason we lost jobs is we closed the economy. It was sort of there was a health impetus to it. It wasn't imbalances in the economy per se, right? So we said, hey, well, we know this is going to turn around, but what kind of shape is it going to take? And we started hypothesizing that it was going to be a V shape, a U shape, an L shape. The square root recovery resonated with me at the time. And you know, I think that's generally what we have seen in Metro Vancouver's recovery and you know, more broadly speaking elsewhere, where we had significant gains early on as we opened sectors back up that were completely shut down. And now we're seeing incremental gains as we sort of extend hours or increase capacity, or yeah, whether that's in a food, like a food setting, a restaurant, cafe setting, or if it's in an office setting. But then there's this dance as well between employers and employees about how do we sort of like, you know, how do employees find the job that they want to be in? How do employers find the right people to grow out of this? So it's been slower growth recently. If we look big picture, Vancouver now, the total employment in this region is 1% above where it was before the pandemic. Montreal is just back at where it was, and Toronto's a little bit up on Vancouver, 2% higher. That's a recent surge. It's a result of a recent surge that they've seen because they've trended below us for quite some time. But you know, we're recovering quite well. We spent much of this time here over the past, like in 2021, with employment levels that were relatively speaking higher than in Toronto and Montreal. But again, if we look at that monthly growth rate in employment, initially, you know, in that first year-ish, 10 months, employment was growing by 2% per month. And then, you know, we go back to this image of a square root sign. More recently, you know, over the past 6 months, we've seen employment grow by 0.2% per month. So a lot slower. So it's very clear that if we continue along this trajectory, and I don't see why we wouldn't, i.e., I don't see how we would achieve, you know, much greater incremental gains in employment, that the tail on COVID is going to be quite long, at least from an employment perspective. We also see, you know, in our labor market, the manifestation of COVID in this huge spike in unemployment. We went from 4.5% unemployment going into the pandemic all the way up to 14%. It's funny, it actually isn't funny at all. But if you look back at 2008, 2009, the so-called capital G Great, capital R recession, which was a very tumultuous time for global economies, and certainly here in North America. I mean, the unemployment rate doubled over a very short period of time. It was very dramatic. It was the worst that we had seen in decades. And, you know, obviously what we've seen more recently trumps that. That being said, as the economy has opened up, expectedly, the unemployment rate has come down. So for Metro Vancouver, we now sit at 6.2%, but that's still quite elevated above where we were going into the pandemic. We're on the right track. We are not back to where we were. It feels like a tenuous situation that we're in right now. And so that manifests itself in changes in the number of unemployed people. The unemployment rate itself doesn't tell the whole story. You're not included in the unemployment statistics if you stop looking for work. So what about those people that are actively looking for work and can't find it? So again, looking at that pre-pandemic point where the pandemic, COVID was not a thing. So it was just a regular old February. And so we had a 4.5% unemployment rate in Metro Vancouver, and we had about 71,000 people who were unemployed. Obviously, we'll never have a 0% unemployment rate. There are always people who are changing jobs, scaling up, or people who just can't find work. But there are always a group of people that are searching and cannot find work at a given point in time. In February, it was 71,000 people. From there, that number grew dramatically, right, to the nadir of the pandemic in terms of its effects on the labor market. We were up to 221,000 people unemployed, but that has generally come down over time. And you can see if we difference the number of unemployed people in a given month from what we saw in February. If February was a sort of baseline, you can see that the excess unemployment that we had peaked in June of 2020 at 150,000. Generally speaking, it's come down. You know, there's some bumps along the way as restrictions have been ramped up in response to rising caseloads. But generally speaking, it's a downward trend. And currently, while the situation is much improved, there are 30,000 more people looking for work who can't find it than before we went into the pandemic, right? And certainly there are many more. I don't have a chart for it, but when we look at discouraged workers, again, these are people that had been looking for work and were so unsuccessful that they dropped out of the labor force because they stopped looking. So they're effectively not part of this calculation anymore. So there's a shadow group as well that's not included here. So there are a lot more unemployed people. Ironically, then, paradoxically, we see rises in the job vacancy rate. So the job vacancy rate is the percentage of jobs, of all jobs that remain unfilled. And so we had a little bit of a gap in visibility on the data in Q2 and Q3. StatsCan didn't publish anything because it was just difficult to collect the data and validate it. So, but coming out of Q4 2020 and into the first quarter of this year, the job vacancy rate nationally rose to an all-time high of 3.6%. It's not quite the same story here in BC and in the Lower Mainland, but we are seeing increases in the vacancy rate. It's not at an all-time high, but it is significantly higher than in Canada as a whole. So employers are really, I guess in a recent context, are increasingly struggling to find the right people to fill roles. And I think part of that is a result of so much. They talk about the Great Resignation. I guess you can call it that. I think there was probably some pent-up demand for job movement. I mean, there were a lot of people who were fortunate to keep their jobs through the first year of the pandemic. Were hesitant to change jobs. You don't want to be last out for fear of being, or last in for fear of being first out in a new role, potentially. So I think there was some pent-up demand for labor market movement that now is starting to manifest, and I think it's just taking some time to find those matches between labor supply and labor demand. But clearly, these job vacancy rates not really going in the direction that we would like to see in a normal functioning economy. When we look at demographic change, BC as a whole, we look at employment or population growth at the beginning of 2020. This is pre-pandemic. We attracted in BC, or we grew by, let's put it that way, about 11,000 people in that first quarter of last year, just in the months before the pandemic. So again, you can consider that somewhat of a baseline. Q1 of this year, we added double that number. There's a few factors that go into it. Births and deaths influence how many people live in a particular jurisdiction. We actually had more deaths than births in Q1 of 2021. Maybe COVID was a little bit part of that, in the sense that we had an elevated number. We had more mortality. Some people were having, generally we saw slightly lower fertility, but we have an aging population and below replacement fertility rates. So, this negative, this more deaths than births at the beginning of this year is something that was coming sooner or later. So we've now seen this for a few quarters. So it's certainly not a surprise, but it means that all of the growth in our provincial population is coming from migration. And, fortunately, I'll say from an economic and a broad market basis, we are an attractive place to be, both for immigrants, if we look at the right-hand side of this chart, and for interprovincial migrants, which is shown right next to it to the left. You can see a big increase in both of those net flows into BC. So we're sort of bouncing back from where we were at the beginning of the pandemic, and then obviously we had there was less movement during the pandemic as well. When it comes to interest rates, another example of how we're sort of not back to where we were. We don't have interest rates where we want them. A lot of us like low interest rates, in the sense that particularly homeowners. I often look at it from that perspective. Obviously, make sure your home, that the increasing asset price or the purchase price notwithstanding, makes your mortgage payments that much cheaper. But we're seeing the overnight target rate from the Bank of Canada, the light gray line on this chart, is effectively at its lower bound, at close to 0%, about 1/7 of what it was going into the pandemic. 5-year Government of Canada bond yields, which influence on the residential side the mortgage market quite significantly, plummeted to around 0.4% at one point, sort of end of 2020, and even into just the beginning of 2021. They're now starting to rise. And so the Bank of Canada has taken its foot off the gas from a monetary policy perspective. They're shutting down the quantitative easing program. So they're not buying net new public debt. So they're no longer demanding that debt that's being issued. So again, at the margin, we see the price of that debt fall and the yield on it start to rise. So we're starting to move back up to pre-pandemic levels on that front. And part of it is we're seeing higher inflation, right? So investors are going to demand higher yields as well as we see inflation surge the way it has. The question is, how long will it last? We'll come back to that in a bit. When we look at public debt, so this is at the federal level, and this is monthly data. Very interesting. Going back 12 years is how far back we have it. It shows on a monthly basis the extent to which federal government revenues exceeded expenditures or vice versa. And so you see, most of the time, the government is actually operating on a deficit basis and adding to debt. Not a bad thing to see the debt grow as the economy is growing, especially in a low or declining interest rate environment. But things really, really changed at the beginning of the pandemic, right? So the right-hand side there, you can see that we've averaged an addition to the debt of about $24 billion a month versus over the previous, whatever you want to call it there, like 12 years, an average debt accumulation of 1.5 billion. So, the supports, the fiscal supports, the extraordinary measures the government went to support businesses, to support individuals and households has taken a toll on this front, and we've seen the debt explode. That said, we're now seeing on a monthly basis that deficit spending decrease, which is a good thing. I mean, eventually you want to see that sort of decline into a normal range. It does frighten people, these huge numbers, whether it's government debt or it's household debt. You see this, these ever ballooning numbers or figures around what people owe, what we owe, and it's a bit scary. And you wonder if we're heading into some sort of debt spiral. The very, very important thing to consider in the current environment is that interest rates are at historical lows and are expected for many years, if not decades, to remain at low levels. So think pre-pandemic levels. I mean, that was still historically low at that point. And so we've seen now an example of how this manifests is in these debt service ratios. So if we look at the percentage of disposable income in Canada that is put towards servicing debt, that's the red line at the top. You can see we're, going into the pandemic, we were around 15%, which was sort of on par with 2007. Started to come up as home prices increased for sure, but interest rates have remained low. When interest rates dropped, two things happened. Interest rates dropped in the early days of the pandemic, and people also started to sock money away and pay off debts and not add to their debts. So the debt service ratio dropped dramatically. It's increased a little bit more recently, but it's very, very manageable, whether we look at it on the private side or the public side. So, at this point in time, as long as we can grow the economy, at a faster rate, then we are paying back interest on our debt, then all will be well in the long run. But obviously, we're going through a bit of a tumultuous time at the moment. Talking about household savings and socking money away, over the past 4 quarters in Canada, Canadian households have saved. So this is the difference between current spending, consider it consumption spending, and income. The difference being savings and capital expenditures, maybe investments in one's house or in new real estate or other assets. But that difference was cumulatively over the past 4 quarters, $250 billion in Canada. And you can see, for context, going back to 5 years, how dramatically different that this past year's experience has been from past year's experience. And again, as I said in the intro, about 100 billion of this is estimated to be in Canadians' bank accounts today. So ready to be deployed into whatever sectors of the economy that people haven't been spending money on. So think about travel and tourism, perhaps, but also investments in assets and, dare I say, real estate. So there we are, sort of a smorgasbord of metrics, but really just sort of giving a sense for how a lot of things are in a disequilibrium state, a little bit out of whack, but largely, all sort of generally speaking, trending back towards the levels that we saw, or the rates that we saw before the pandemic. So we are in recovery mode. That being said, our region has performed quite well through the pandemic to this point in time. So there's us out in front. Most other metros in the country, other provinces are lagging us, not in every way and not always by this much, as insinuated by this photo, but Metro Vancouver has performed quite well. So looking at the share of jobs initially lost in the early days of the pandemic that have been recovered. So these are current employment levels relative to before the pandemic started. So you can see that Canada there, just to the right of the dotted line, Canada as a whole is essentially just back to where it was pre-pandemic. BC leads the country amongst major metros and provinces in terms of employment recovered. So we're 10% above our pre-pandemic employment levels, Vancouver 7% above. So we're faring quite well in that regard. On the unemployment rate front, again, you can see where Metro Vancouver's unemployment rate spiked to north of 14% during the depths of the pandemic, coming off of 4.5% just before that, and a 5-year average of 5%. So essentially tripling. And now we're down to, this is a chart from the landscape, so it's about a month old, but we're down here to 7.5%. And we know more recently we've come down closer to 6%. So our labor market is tightening at a rate that is, generally speaking, faster than what we're seeing in other parts of the country. The fact that our labor market has been stabilizing, the fact that fiscal supports for households, for businesses was so robust, and quite frankly, because we, it was, I think, a great decision to implement that mortgage deferral program in the early days of the pandemic that gave homeowners up to 6 months of no payments if they weren't able to make them on their principal residence. That really helped to stabilize the mortgage market as well, because we've seen mortgage arrears rates across the country come down. And Vancouver, which has some of the lowest arrears rates in the country at 13, so the 0.13% says that 13 out of 10,000 mortgage holders are 3 or more months in arrears on their mortgage. So it's a very small number, and it's been declining as well. So the mortgage market here has stabilized considerably, and our arrears rate versus the national average continues to be much, much lower. On the demographic front, this chart has been making the rounds recently in meetings that I've had, so that people really are sort of in awe of this. Looking back over the past 5 quarters, so back to Q2 of last year, on a net basis, cumulatively, BC has attracted 43,000 people from other parts of the country. So 43,000 more people have come to BC than have gone to other parts of Canada. And the second most popular destination, if you want to call it that, is Nova Scotia with just under 12,000. So there's a huge chasm there. Interestingly, you also see New Brunswick, PEI, Newfoundland on a net basis having added people, whereas essentially all the other provinces, most of the other territories, lost significantly. So BC has attracted people from Ontario, Alberta, everywhere. Ontario, Alberta, Saskatchewan, Manitoba, Quebec, you name it. People have been coming west. So there's almost been a bifurcation in domestic migration flows. Some people, obviously, as we can see here at the margin, going to the East Coast. Like, you know what? Forget this life. I can work remotely. I can also buy 200 feet of waterfront and a house for, $300,000. So I'm going to go live out my days out there, or at least for a while. Other people said, hey, I'm going to go west. I'd say the same sort of lifestyle calculus as people moving east. But, obviously real estate, land is more expensive here, but we have a more robust labor market. And we've also been quite successful in managing COVID and getting people vaccinated. So BC is a very attractive place, has been for Canadians, and I expect that to be the case going forward. Interestingly, all this, the active labor market, the secure mortgage market, the migration flows out west has really, I focus a bit on housing here because it's what I do, but has led to some really interesting dynamics in our housing markets. And I used the word bifurcation earlier about the directional flows of domestic migration. There's been a bifurcation in our housing market, at least in the early days of COVID, when you look at ownership versus rental, where the rental market, I won't get into it now, I think a lot of us know why, for the brunt on the housing side of the pandemic, the ownership market, for a whole bunch of other reasons, has been thriving. Thriving if you're an existing owner, not thriving if you're trying to get in and can't. One of the manifestations of all the activity is an all-time low now in inventory. So when we look at the Vancouver region, I'm talking about, for those who are tuned into these things, the Greater Vancouver Real Estate Board area, as well as the Fraser Valley Real Estate Board area. So essentially north and south of the Fraser, effectively Metro Vancouver with Abbotsford thrown in. So for the broad region, we've got, at the end of September, we had 12,000 listings, which, the data go back to 1989, it's as far back as we can go. It's the fewest listings we've ever seen. There's just not a lot. It's slim pickings out there. There's not a lot available if you want to purchase a home in the resale market. We track stuff on a daily basis here at Rennie, some stuff on an hourly basis, but when it comes to sales and inventory and that kind of thing in our resale market on a daily basis. In the middle of this chart, you've got October, we've got full month, and you can see at the end of October, there were fewer than 11,000 listings. So inventory has continued to come down, and I just took a snapshot yesterday or 2 days ago of inventory in this region, and it's down to 10,500. So we are inching closer and closer to being in the 4 digits instead of the 5 digits. So there's just not very much out there because demand has been so strong. So when we look at, you say, hey, is this specific to an area? Because definitely there were some very notable spatial patterns of change in our region early on. People moved away from condos, moved away from urban areas, went into less densely populated areas, the valley, where you could get more space, more bang for your buck. But when you look at inventory changes in September on a year-over-year basis, this is all housing. We just see declines everywhere, right? If you say, hey, well, what about on a product type basis? What about condos? Oh, no, inventory is down everywhere. Well, what about townhomes? Inventory is down everywhere. What about houses? You go, it's down everywhere. Oh, on the west side. Okay, so there's been an increase in inventory on the west side. So if you happen to have $3.5 million for a house, it's the average selling price on the west side currently. You have some options. You have more options today than you had a year ago. But for every other product type in all parts of our region, supply is constrained. Now, as I mentioned, do a time check here. We're fine. Sales have been robust. It's an interesting story on the sales front because clearly early in the year, it was like a rocket ship taking off. We hit almost 9,000 MLS sales in March, an all-time record for any month ever in this region's history. We have data going back to 1978. So that was the most sales we've ever seen. But then you start to talk to realtors and you go, well, since March, every single month, as this chart shows, sales have been declining. So, from a day-to-day perspective, that experiential perspective, the market's been slowing. But importantly, if we look at the past 10-year average of sales for each of the months year to date, you can see that 2021 has outperformed those, right? And so here is the differential in percentage terms. Even though that gap has closed more recently, in September, we had 30% more sales than we would typically expect in September. So sales have been very, very strong. If we look again at the middle of this chart for October, we just tallied more than 5,000 once again. So September, in a sense, was a bit of a blip on the radar, dipping below 5,000. November now, early days. We're averaging 250 sales a day through the first couple of days. So we're on pace for more than 5,000 again, which would be a very, very robust November. So that's one side of it, is the sales side. And it's interesting then to think about what's happening with new listings? Because I often think about sort of the relationship between sales, inventory or total listings, and new listings in the context of a bathtub, right? So inventory or total listings is the amount of water that's in the tub at a given point in time. Sales represent water flowing out of the drain. right? So if all else being equal, the drain opens up more, or there's more pressure in the tub, whatever, more water flowing out, it's going to draw down inventory, right? But then obviously the other part of the equation is how much water is being added to the tub, and that's the new listings. And at first blush, it looks like new listings activity has sort of waned recently. So this is monthly data, monthly new listings for the region. You can see the 7351 in September, 24% below last year's new listings, so down significantly, and also 6% below the 10-year average for September. However, that is more a feature of the last couple of months where new listings have slowed. If we roll up new listings and we aggregate them over a rolling 12-month period and present them on a monthly basis here, you can see that over the past 6-7 months, we have been over in excess of 100,000 in almost every month except for the more recent one. But all of these months represent all-time highs in new listings. So we've had inventory declining to historic lows in the face of very robust sales, despite the fact that we've had a lot of new listings activity. And thank goodness we have, because imagine a world where we hadn't had that new inflow of supply. Because this chart shows the year-over-year change in prices, MLS prices, benchmark prices of detached homes, townhomes, and condos. You can see detached is the red line. Most recently, prices have increased 26% year over year. So that rate has been increasing generally. It's not quite at the peak of what we saw in those heady, crazy days of 2016, but it's high. It's unsustainably high, and that also applies to townhomes. And quite honestly, at 12%, that applies to condos as well. Though I expect there's some room to run there for those, and that we'll see those come up on a year-over-year basis as well. But if it weren't for new listings, I don't know where these numbers would be. So there's a lot of demand on the resale side. On the pre-sale side as well, activity's been incredibly robust. And we always say that conditions in the resale market set expectations for buyers in pre-sale, right? So in other words, we have so much access to MLS data, it gets reported on all the time. So we're always hearing, every month we sort of get reinforced that prices are going up or they're going down or something. There's direction to them. And the story over the past year and a half is they've been going up, 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 up. So when you look at the pre-sale market and that investment possibility, you say, hey, I have confidence that prices are going to be higher in 3-4 years when I take possession of my home. So this is a worthwhile investment to put 15-20% down today, that I'll be making money before this thing is built. So I think there's a lot of confidence in pre-sale. In Q1 and Q2 of this year, we just massively outpaced anything that we saw in 2020. And then the initial estimate, though it's not yet set in stone, is that we had an excess of 50 or 5,000 pre-sales in Q3. I expect that number probably to get up to around 5,500 once all the projects have been counted and the homes have been counted. But we're now sitting at around 18,000 pre-sales for 2021. We're only 2,000 below the all-time high that we saw in 2016, which was just over 20,000. So we're on pace to have the best pre-sale year from a sales perspective in the region ever. And then on the flip side, it's a similar supply story where we look at the number, like the amount of inventory, the amount of homes that have been released, available for purchase that have not been on the pre-sale front. And we've seen a dip in inventory in both Q1 and Q2, even though the number of projects launched the cadence of those has increased. Okay, looking ahead, and let me see here. Okay, we're totally good for time. As we look ahead, I'm not going to give you any predictions. The reason I don't, and I've said this for a long time, is when it comes to predicting things, like for example, prices, there are so many factors that come into play, and prices, whether it's for oil or for real estate or whatever, represent implicitly an intersection between supply and demand. A bunch of factors on the demand side, a bunch of factors on the supply side that come together to yield a value. So to predict a price, you've got to be accurately predicting or get lucky predicting supply and demand conditions. And the perilousness of this was just reinforced yesterday or the day before with Zillow's iBuy program being shut down. They took a write-down of hundreds of millions of dollars. They had algorithms to predict prices in the market. They got too aggressive in the residential real estate market in the States. They got too aggressive with their offers, just as prices were sort of flatlining in the States, and they realized that the business model was untenable. And the CEO's comments were, you know what, they put a bunch of resources into their algorithms to forecast prices. This is Zillow. And he admitted defeat and said, you know what, it wasn't good enough. We were not able to predict prices. And they're not looking to predict prices 5 years from now. They're looking a year out, because they're turning these things around pretty quickly. So I think that was a very interesting admission, and a telling one as well, just sort of underscoring how difficult it is, and you know, how skeptical we should be when we do see people forecasting, or groups forecasting prices. CMHC, another example at the beginning of the pandemic, said that Canadian house prices would decline by between 9 and 18% on average by the end of 2020. And it was actually quite the opposite. And they have a lot of smart people and a lot of data and a lot of analytical firepower, and they got it wrong. It's not a criticism. It's just, it underscores how difficult forecasting is. So I'm not going to forecast. I'm not going to predict, but I'd like to talk about a few things that we're looking at as we head into 2022. One of those is sort of, you know, confidence is a big thing. We look at outcomes often, like sales. How much are people spending in retail? How many homes are transacting? How much office space is being leased? It represents it's some finality to a desire on one side to do one thing, and the desire on the other side to do something else. So a buyer and a seller come together and manifest in a transaction. But expectations of consumers and businesses matter as well, because people will and businesses will invest and spend based on what they think the future holds. So even if things are jolly good right now, and in fact the future is very, very bright, if our mindset is that we're pessimistic, then we're not going to buy a new couch or invest in a new deck. Or for a business, we're not necessarily going to look to expand the workforce or invest in technology, right? So expectations matter. The Q3 survey of businesses by StatsCan across Canada, looking at their perspective over the next 12 months, indicated 3/4 of businesses were optimistic about the next 12 months. And that's not totally unsurprising, because we're in this recovery phase. We're coming out of the pandemic, and hopefully soon it's in our rearview mirror. At some point in 2022, we can talk about growth. But this indicates that, hey, businesses are poised to spend. They're looking to hire, they're looking to invest, and that's a good thing for our economy. From the consumer side of things, we're actually working on a consumer sentiment survey in this region. We'll have the results in a few weeks. But we can sort of use retail sales and consumer spending as being indicative of how strongly or how positively people feel about their financial situation. So on the right-hand side here, we've got Metro Vancouver year-over-year retail spending through June, up 19%. So from the depths of the pandemic to today, you go, okay, it's just a rebound. But you know, in the previous year is at 1.1%. So people clearly are, if they're not freewheeling, they're at least comfortable spending money again. And I think that is consumer spending is 60% of our GDP. So the fact that consumers are spending is a positive sign. They're spending in ways that maybe are in patterns that are different from in the past, that is leading to some inflationary pressures, amongst other factors, influencing inflation in various sectors in the economy. We look at the experience with inflation right now. As of the Landscapes publication, it was at 3.7% nationally. It's now over 4%. But the experience within that across sectors is very, very different. So for example, if we look at energy, which includes, a large component of that is gasoline, it's a 20% increase on a year-over-year basis. And so there's some base year effects here, where last year gasoline prices were depressed because people weren't driving to work, they weren't really traveling, so the demand was low, and it surged back. So that is driving a lot of inflation today. On the flip side, clothing prices, maybe not the clothing you're buying, I don't know, but on average, clothing prices are up per this index 1%, which is significantly below the bank's target inflation rate of 2%. So the experience, there's some nuance to the inflation numbers. And certainly when we look at the different measures of inflation that the Bank of Canada uses, on the left is their all items, which is the entire basket in the consumer price index. And then to the right, different variations where they take out the most volatile ones, volatile sectors, both on the positive and the negative side. There's also the CPI, I should say median, not medium, but that's where they look at they line up all of the changes in prices and they take the middle one. That takes us at 2.6%. And then 1.7 is a narrower band as well that looks at even less volatile, sort of more standard areas of spending and those sectors and how prices are changing there. And you can see that we go from 3.7% at the top side to 1.7%. The bank considers all of these when making its rate decisions. So, you know, these 3 out of the 4 inflation rates at the time, so this is as of June, we're essentially in that 1 to 3% band target range of the Bank of Canada. So not massively out of whack. Inflation is definitely on the rise, but there's a lot of different ways that we can look at this and understand it to put some perspective on this before we all jump to the conclusion that interest rates need to go up by a factor of 10 to quell inflation. So I think prices will continue to rise. I think I'll admit it, I'll still go out on this limb and say I'm on team transitory. If we look at sort of the balance of evidence when it comes to inflation, that I still lean more towards it being transitory. What does that mean? It means we're going to have high inflation for months to come, but this is not a permanent feature of our economic landscape. So I do think we're going to see that abate as we head into next year. Part of that is, you know, the wage inflation that we're starting to hear about and see creep in because workers are demanding more or they won't work is partially the result of the generous, you know, fiscal supports that governments have provided. And that money is not going to be around forever. It is still around, but there will be a point where I think, you know, workers will migrate back into the job market with weaker wage demands than they have right now. So that will influence inflation as we move forward, as will, you know, at the margin, rising interest rates. Immigration was suppressed in 2020 across Canada. We got about half of the immigrants that we typically would expect at 185,000. Transition into 2021 and beyond, the federal government set targets in excess of 400,000 for each of the next 3 years to make up for that COVID crater, right? Because we have immigration primarily to support the labor market, our tax base, and our economy. And we didn't get nearly enough immigrants, given our aging population, to keep us on the path that we want to be on. So the targets have increased to record levels. Through August, we've had 222,000 immigrants or permanent residents admitted to Canada. Based on the last 3 months of 37,000 permanent resident admissions to Canada, if we extrapolate that over the remaining 4 months of the year, that takes us up to 373,000 immigrants for 2021 full year. An amazing number given our borders have been closed for a long time, but also it would be the highest on record. So we're short of the target, but we're close, and it would represent a big bounce back from 2020. So expect that number, we will, you know, a new variant in COVID or some unanticipated direction related to the pandemic notwithstanding, we will hit our targets in each of the next 2 years for immigration. And I wouldn't be surprised if the federal government actually incrementally increase those targets as well. So there'll be more people looking for housing and more people to fill jobs. Another view into international migration in Canada, monthly data, breaking it down by permanent residents or immigrants in red, and then students is the dark gray. Then we also have people who are here in the with temporary foreign workers and also as part of the international mobility program, which is yellow. And you can see on a year-over-year basis, most recently, that we've seen increases essentially across the board. Students are another story here. They disappeared in 2020, international students, and they're coming back with some force to this point in 2021. I see that having a very significant impact on the rental market. Interest rates, obviously, we survey the banks, BMO, TD, RBC, just a selection to say, hey, you know, like, where are interest rates? 5-year Government of Canada bond yields here is the proxy for it, quote unquote, interest rates. Where are they going? Everybody expects interest rates to increase. The degree to which is, you know, up for debate. I think TD currently, you know, looking at close to 2% for 5-year Government of Canada bond yield by the end of 2022 is the most on track. BMO and RBC a little bit more conservative. But, you know, I wouldn't be surprised if we saw it north of 2% by the end of next year. which then would take, the 5-year fixed mortgage rates up to, probably the high twos again, which is where they were before the pandemic. We're talking 279 to 299, something like that. And then just one chart here just about foreign buyers, because it was a plank in the platform of a number of federal parties going into the September election. Obviously, the Liberals came out as with the minority government once again, but philosophically, they're aligned with the Conservatives in that they would like to ban foreign buyers in Canada. So people who are not permanent residents from purchasing residential real estate for a period of 2 years. Now, I haven't heard any plans since they've been reelected to actually implement this, but you do have to ask yourself, like, why? What's up with this policy? Well, one, it's low-hanging fruit because non-permanent residents of Canada can't vote. There's no political downside really to targeting this group, this demographic, and it sounds good. It's like, hey, if you're not like committed to Canada, if you're not by way of actually living here, working here, paying taxes, then we don't want you taking housing supply away from somebody who is here doing all those other things. The reality is, whether you agree or disagree with that, even in Metro Vancouver, where foreign buyers has been such a hot topic for so long, if we look at that red line there, that's the share of all residential purchases on a monthly basis over the past few years that have gone to foreign buyers. So foreign buyers being, in this case, defined as non-Canadian citizens, right? So that's how they define it. So you can be living here, you can be working here and paying taxes, but if you're not a permanent resident, then you are a foreign buyer by definition. At the same time, if you're a Canadian living in another country, but you don't, and you can buy property here and not live here, and that's okay. You're not classified as a foreign buyer in that sense. So either way, we're talking about most recently 1.2% of purchases being to foreign buyers. So we're talking 500 to 800 purchases in Metro Vancouver per year that are to foreign buyers. A ban, to me, will not have a material impact on our residential market here. If anything, in the short term, between the time a ban is announced and the time it's implemented, we actually could see a surge in activity. So it could have some ironic effects on the market in the near term. But I really don't think that this is something that gets a lot of attention. I don't think it's going to have a significant impact next year or beyond. And then as we look ahead, I think from a COVID perspective, who knows? We didn't predict COVID was coming. We didn't know the depths that we would end up in based on the ubiquity of COVID. But we now have one of the highest vaccination rates in Canada, and Canada has one of the highest vaccination rates in the entire world. And if we look at BC's daily new case count more recently, we've seen it decline now for almost 2 months. So it's still relatively high, but it's manageable and headed in the right direction. So I think there is a point here as we get more and more of the population vaccinated that even those who do get COVID, barring any sort of significant variants, which again, not something we can predict. I do think that we are poised, at least here in British Columbia and Metro Vancouver, to really start looking ahead instead of looking in the rearview mirror and thinking about, how we're going to grow and what the world is going to look like as we come out of the depths of COVID. So there you go. A rambling essay on, where we've come from, where we're at, where we're going type of thing. There's, again, the Rennie landscape can be found on our website, rennie.com/intelligence. You can sign up and choose publications that you want. We publish a number of different reports on a monthly, semi-annually, and annual basis. You don't have to get everything. You can pick and choose, but go check it out. And of course, I'm very open to conversations about what we do or about the market. So you can always shoot me an email, give me a call. Just go to our website. That is it for me, but I'm happy to take some questions. So maybe I'll punt it back to you, Devin, and or Lucas.
We just got a couple of questions here. First one, I've heard about a K-shaped recovery through COVID, where the top part of the market has increased and the bottom part has gotten worse. Have you seen this in the BC labor market at all?
Yeah, that's, I neglected to, because I didn't want to get into it for the sake of time earlier, I neglected to mention the K-shape. So that's one where a certain segment of the population of the market recovers faster than another segment. COVID had a K-shaped impact on our market and on people in this region, in the sense that, quite simply, if you are a homeowner, you've benefited by and large from the pandemic. It's a perverse thing to say, but it's generally true, because if you're a homeowner, you're probably a little bit older, you probably have a certain type of job that was office-based, perhaps, that was not in an aggregate sense as affected as people who were in retail, hospitality, food, that kind of stuff. And so those are younger people making hourly wages who tended to rent. And so that's where we saw vacancy rate in the rental market go up. We saw rents sort of soften. They continued to increase, but they softened. And we saw significant layoffs amongst young, lower income earners. And of course, on the flip side, we had homeowners who realized significant gains in the value of their property. So, I think coming out of this as well, the recovery has actually, favored the lower income younger workers, but only because they were the ones that lost their jobs. So we see employment in those sectors rising faster than elsewhere. But we're going to see a legacy effect of the pandemic, policy notwithstanding, new policy, interventionist policy notwithstanding, whereby people who owned things, land, who had the office type of job going into the pandemic, they are going to come out a little bit better. So, I think you can have both a square root recovery and a K-shaped recovery at the same time. And I would agree, if that's how it was framed, that we are seeing that now.
Just another question. How does during COVID migration to BC compare to pre-COVID? And what's your best guess on how it will look in 2022 and beyond?
Yeah, from a domestic perspective, it's been through the roof. It's been very elevated. So, for example, I showed the chart at the beginning of this presentation for BC. It was quarterly data, and we had, I believe that those data were for Q1 of this year. We now have Q2, but so it's still relatively new data or recent data. But for Q1 of this year, we had 9,000 net domestic migrants to BC, and Q1 of 2020, that was pre-COVID. We only had 3,000. So I think we see, particularly on the domestic front, we see the net migration flows, like the ebb and the flow of people in this country, is largely influenced by economic performance, right? So to the extent that BC's labor market continues to perform comparatively well, that our unemployment rate stays comparatively low and it's declining, and that there are opportunities to earn money here, to work, I think we're going to continue to see that. And I think that lifestyle, I know it's expensive as hell here, but lifestyle matters more to people now than it ever did before. So I think, and the fact that people can work remotely, I know it's way overblown the extent to which I think people will work remotely long term, but we know we can. And there are certain tasks and occupations and sectors that lend themselves more to that than being in an office environment. So I think at the margin, we are going to see for some time stronger inflows to the West. And I think that applies on the immigration front too, as we see elevated immigration targets, 400,000 over the next few years. Each year, 14% of those end up in BC, 90% of those end up in Metro Vancouver. So think of Metro Vancouver as getting 1 out of every 9 immigrants that comes to Canada. So I think, I don't know what it means. It means more, a greater need for housing. It means that the labor supply pool is going to be more robust than it is today, and it has been. But it's going to be an interesting few years for sure.